The minutes of the December 7th monetary policy meeting showed deep divisions within the six-member MPC. The Reserve Bank Governor and the Deputy Governor, Dr. Michael Patra, sound quite worried about inflation. Governor Das warns that a premature pause in monetary policy action would be a costly policy error at this juncture. Likewise, Dr. Patra deeply worried about core inflation getting persistent. But on the other hand, external member Jayanth Varma believes the repo rate at 6/4 already overshoots what is needed to achieve price stability, and that the committee's stance could be actually damaging to the already fragile growth. Ashima Goyal, another external member, believes it is time to move to a neutral stance where movement can be data-based in any required direction. The other external member, Dr. Shashanka Bhide, however, agrees that it is important to get to the 4% inflation target, and not achieving growth and inflation target would be a very poor outcome. So, more or less siding with what the Governor and Deputy Governor Patra and Dr. Ranjan had to say. I'm now joined by the external members of the MPC, Dr. Shashanka Bhide, Jayanth Varma and Ashima Goyal, to let us know their part of the argument. We already heard the internal members, the RBI members, on the policy day. So, Dr. Varma, Dr. Goyal and Dr. Bhide, thank you very much indeed for joining me. Dr. Varma, let me start with you, since you have voted against both the hike as well as the stance. Let us have your say first. Why are you so worried about growth when everyone is beating their chest that we are the fastest growing economy in the world?
You see, I think the way I'm looking at it is that monetary policy is a trade-off between inflation and growth. And for the last year and a half or so, the pressure was on inflation, the risks were on inflation, and it was necessary to focus more on inflation and underemphasize the growth side. But the developments recently are pushing the balance in the opposite direction. And inflation is coming under control, and growth is fragile. I'm not saying that we're not growing, we're growing, of course, but the growth is extremely fragile. First of all, there are headwinds from the global economy. Our exports growth has crawled to a standstill. And, we are not sure, capital investment has not revived. So the sources of growth are very limited, they're very fragile. And it's possible that once the pent-up demand is over, we don't know where the demand is going to come from. On the other hand, the inflationary pressures have significantly come down. Commodity prices are well off their highs, and we see the picture on inflation as becoming much more manageable than before.
Okay. Dr. Varma, let me take that argument to Ashima Goyal. Dr. Goyal, is inflation so much under control? After all, core inflation is still at 6%. And if you looked at the November numbers, which of course you did not have when you were making the decision, the fall in inflation has come only from vegetables, nothing else. So is there not a cause for concern that you guys are way off target on inflation?
No, I think we are seeing signs
Ashima,
that there is a pass-through.
Yeah, sorry. Yeah. Go ahead, please. Sorry.
You can hear me?
I can. Go ahead. Sorry.
No. I think there are signs that the resolution of global supply shocks, the supply chain issues being resolved, commodity prices softening, are coming through in inflation. And my own view of core inflation is that this persistence is because of multiple supply shocks that we've seen through this period of pluri-shocks. First, the global supply chains, the pandemic, the Ukraine war. So it may look persistent, but it is still supply shock driven largely, not so much demand driven. And that is why, but I believe that is why I'm not so worried about core inflation. I think there are signs that it is softening, but I think that demand does need to be moderated somewhat in the Indian economy because of the large current account deficit. If there are multiple persistent oil shocks, then it's a terms of trade shock against which which affects our potential output somewhat. It reduces. So that is why I voted for a rate hike. And overall, I think policy has raised rates aggressively in this period of inflation. And now we can sort of wait, and as long as we make sure, and our forward forecasts are falling of inflation, the real rate ex ante is positive. So this will work to decrease demand adequately and maintain a balance between reducing inflation as well as not really hurting growth. Because I think we are ready for a turnaround in growth in many areas, including investment, including real estate, and so on.
Okay. So your point would be that further hikes are not needed?
It depends on data, as I said. So currently the data is showing that inflation is coming down. And my own view is that once you are within the tolerance band, in the current situation of a global slowdown and uncertain growth, you don't need to aggressively raise rates further.
Okay.
And because real rates are going to be rising, real interest rates, as inflation falls. And that will be more of a negative dampening that will continue to dampen demand adequately.
Okay. Well, I will take issue with that a little later. I think savers have suffered long enough. And at the first sign of positive real rates, if you are going to flinch from it, there is one important constituency that will be upset. But I'll come to that in just a minute. Dr. Goyal, let me get Dr. Bhide in. Dr. Bhide, would you say that having come within the 6% mark, the MPC has more work to do to come to the 4% target on CPI? Is that your point, really?
Yeah. Yeah, certainly. I think the concern really is that there is uncertainty over the both growth and inflation trajectories. Yes. And I think at this point, it is important that the inflation is brought within the target band. And I think so. I think that certainly is a key objective of the policy for now, because the uncertainty on growth is equally significant, and I think, and it's important, I think, that we bring down the inflation rate, even when there is some concern that the growth is sort of subsiding. I think the inflation will remain a concern until we bring it to more moderate levels.
Yes. I want to pose that question as well to Dr. Varma. But Dr. Varma, in the first place, are you so confident that core inflation will come down? The Reserve Bank internal team seems equally confident that it is going to remain at 6% for a year, and definitely even headline inflation, for which the MPC is responsible, is not coming within 4% for over a year. I mean, in December 2023, we will still be talking, and CPI will not be at 4%. Doesn't that bother you?
Okay, now, see, one issue with these forecasts, both the RBI forecasts and many professional forecasters, they are still assuming that crude oil will remain at $100. That's the basis of all those forecasts. And the crude oil price since mid-November has been around $80. So we're talking about a 20% error in the forecast. You're using a wrong number in arriving at your forecast. When crude oil markets, not just the spot price, the 1 year ahead forward curve, the entire futures curve is around 80 or below. And then you are forecasting inflation, assuming that crude oil will be $100. You are saying that the markets are all wrong, that Brent crude futures market is a bunch of idiots that don't know what the crude oil
No, Dr.
$80 is wrong.
No, Dr. Varma, your point on $100 is taken, considering that it's at $80, both spot and futures. But would that account for the entire inflation forecast being at 5.4%? The target is 4%. Maybe 5.4% would be 5.2%. But you're nowhere near, we are nowhere near 4%. That still lodges some responsibility on the MPC to continue to bring down inflation, isn't it? That's your given mandate. And I think in the last 3 years of this MPC's existence, for almost 30 months, it has not been under 4. Should not that have some weight?
True. See, the issue is that in the monetary tightening was postponed in 2021, right? That is what has led to high inflation today. We should have tightened in 2021 much more than we did. And because monetary policy acts with lags, that delay in tightening is what has caused high inflation today, not just in India, across the world. All central banks postponed the tightening in 2021. They began tightening early in 2022. And that, because monetary policy has a lag of year to year and a half, we are seeing the impact of that now. Now, what we have done is that we have done more about 290 basis points of tightening, include the reverse repo convergence, in the last few months. This is going to have an effect, 6 months to 1 year down the line. So in 2023 is when all this tightening will have its impact. Now, there is nothing that we, keeping on tightening today to compensate for not tightening in 2021. That reminds me of that. The employee is asked by his boss, why have you come late to the office? And he says, I will compensate by leaving early. Now, you can't compensate for an error in 2021 by making an opposite error in 2022. That's what we're doing. That we made an error in not tightening in 2021 that gave us high inflation. You can't compensate for that by saying we will tighten more than required in 2022 and produce a recession in 2023. So one error is not the compensation for another error. One has to look at the accumulated tightening that has happened. What will that achieve? Yeah. And then ask, have we done enough?
Okay. No, I'm not sure at any point in time the other 5 members are saying that we are tightening now because we didn't tighten earlier or we were loose for too long. I don't think that argument is there. I'm asking you a slightly different question. I'm saying that your mandate is 4% and you are not near that. And even if you take crude at $80, I don't think any forecast brings it near 4% for the next 12 months. Is not that, violating the mandate?
No, you see, we have,
Dr. Varma.
We have a target of 4. We have to bring it down to 4. There is no question about that. Our target is not 5. Our target is not 6. That's very clear. Our target is 4. Granted. But we also have a mandate to do this while taking growth into account. Mm-hmm. And the reality is that growth has been below expectations for longer than inflation has been about target.
Okay.
Right? This is the problem. We are having a problem with both. From around 2019, growth has been unsatisfactory. That's why the easing cycle began.
Yes.
And that easing cycle was ended without bringing growth to a satisfactory level. Okay. You take off the base effects, the growth is still unsatisfactory. Fair. So question is, what is the trade-off between growth, which is unsatisfactory, and inflation, which is unsatisfactory? Okay. And the answer that we are doing is that there is a great deal of urgency in bringing inflation down well below 6%. But the speed with which we bring it down to below 4, that is going to depend upon how well the growth side stacks up. Okay. Because that's where the trade-off would come in. Once it is within the band, the speed with which it is brought down to 4 has to depend upon what is happening to the growth mandate. If we ignore the growth mandate, we can take the repo rate to 10% and bring inflation down to 4 very quickly. That, I think, is not our mandate. Our mandate is to consider a trade-off between the two and have a glide path to inflation which balances this. Therefore, there is a great deal of urgency in bringing it down well below 6. Okay. But the target of bringing it down to 4 has to depend on what is happening to growth.
All right. Ashima Goyal, how would you interpret this mandate? You know, it's quite possible that this MPC is going to end its term in another year, and it will find that for an overwhelming part, it has not brought inflation down to 4. And you don't have a growth target. You just have to ensure that growth is sustainable. So, therefore, the polemics between growth and inflation, how do you interpret it, and what should be the urgency of getting to 4? I think you're on mute now, for sure.
Remember that this MPC's term has coincided with pluri-shocks, with a once-in-a-100-year pandemic and so on. And in this period, you have to support the absolute crashing of livelihood, and you cannot afford to ignore that. So given that, and also considering India's, I've heard from many people that many analysts that they think Indian central bank has balanced growth and inflation very well in a very difficult period. And then to come to the dharma of inflation targeting, it is to raise your nominal rate, your repo rate with inflation, so that one-to-one with inflation, so that the forward rate is positive. It is near neutral. The fact that the MPC responds to inflation, responds to ensure real rates are positive, is what anchors inflation expectations. We are doing that. Second, it is to bring down excess demand. There's no excess demand in the system, but reduced demand, and that happens in a lagged fashion over time.
Sure.
And all our pass-through has not happened, less than 50%. So whatever we have raised is going to continue to decrease demand in the system. So we need to let that happen without just raising rates like crazy just now.
Well, this level of 3.35 that reverse repo went to is unnatural for an Indian situation, even if you took our long-term rate of growth. So to keep on comparing ourselves to the 3.35%, I mean, it was an extremely unnatural situation.
We are not comparing.
We've never been that, except for maybe during the GFC for a year, and maybe for a year during COVID. At that time, we were in deeply negative real rates. Ashima, to come to how you see real rates, do you think it should be it will be 85 basis when inflation falls to 5.4? If it falls to 5.4, is that a good enough rate for you? 85 basis real positive rate?
No, it depends on, as I said, data-based. It depends on what is happening to inflation and growth. If we see inflation, as Dr. Varma expects, oil prices remain soft and the pass-through happens. It has not passed through yet to domestic fuel prices. And inflation is softening, and it's falling to 4%. Then the real rate is going to be 2.25. Then we don't need to raise rates. And if we are seeing that demand is contracting because there's a global slowdown and investment is not taking off and exports are really soft, then also we don't need to raise rates more. But if it is the reverse,
you seriously expect 4% in 12 months? RBI says it's nowhere in the horizon. I mean, the RBI internal members, I mean.
As I said, my belief is that the core inflation persistence is because of multiple supply shocks. We have seen multiple supply shocks in the period. It is persistent, but because of these supply shocks. So we will see softening. These forecasts have large bands of uncertainty.
Of course. All forecasts these days have, and in all countries. Dr. Bhide, what is, in your mind, a correct real rate for India?
I'm not sure. I think I would put a number on what the real rate should be, and I think it should be positive. So I think the real concern is that to make sure that the inflation trajectory is on a sustained basis, I think gets closer to the target. I think that is the mandate that we have. I think the discussion that we have had also, should consider that there were these huge shocks that we went through. I mean, Ashima mentioned obviously the pandemic, but also I think what happened after February is also quite unexpected.
That's true.
I think in February meeting, we were projecting something like 4% growth in another 3 quarters or so. So I guess these shocks have certainly changed completely. I think what the policy should be. Yeah. I think at this stage of where we are, it is important that the momentum of moderation in inflation that is sustained.
Okay. Take your point, sir, but you wouldn't think that, 1%, you don't want to hazard a guess on what would, not guess actually, an actual argument on what should be the real rate. Should it be 100 basis? Should it be 70? You have something in mind? No.
No, I don't think I would want to put a number on that.
Okay. Let me try if other members have something in mind in terms of a range. Dr. Varma?
No, I think there is a lot of uncertainty about, in the estimations of what the, the neutral rate should be. Most estimates would give you a band from 0.5% to 1%, 1.25%. So, but it's very hard to put a precise number on that. Okay. And the additional uncertainty is that we're working with an inflation forecast as well. Mm. So whether the nominal rate is consistent with, a neutral rate or not, there are two big uncertainties. We don't know what the neutral real rate is. We don't know what the inflation number is.
Yeah, we don't know what the forward inflation number is. But these are the difficulties that all MPCs everywhere have to work with. And you have to give probably a reasonable band of acceptance to what is being calculated. I take your point that the assumption of $100 is perhaps not is definitely not in concert with what the prevailing rates are. But even given $80, we are far off target. So anyway, there are bands of uncertainty there. Ashima Goyal, any thoughts on real rate? Closer to 50, closer to 100, what would you work towards?
I have sort of watched monetary policy over the last decade and the slowdown that we had. And I know that after the global financial crisis, real rates were highly negative.
Yes.
And in 2018 and 16, when oil prices crashed and we were on the glide path, then real rates became 4-5%, and we saw that growth crash, investment crashed. So I personally would like that the real rate does not go above 1%. And I think that this is adequate because savers, you were worried about savers.
Yes.
In the Indian system, we have very large spreads over the repo rate. And savers have a lot of variety of instruments now. They can participate in equity capital gains and other instruments. So we are seeing that the share of financial savings is rising.
Yep.
And this is one of the strengths of the economy. Our financial sector as a whole is robust. Banks as well as, others are doing well. So, and we are seeing that even though repo rates are rising, feedback from industry is that they are finding financing conditions becoming easier because as demand revives and the banks are, more willing to lend, etc. So overall, I think India is in a sweet spot. And as long as we balance without going overboard, we don't overreact and we maintain this, the ideal balance between inflation and growth, we will do well, hopefully.
I agree with you. Dr. Bhide, we have since got more uncertainties coming in. There is a slight, renewed fear of COVID, infections rising in China, and the Indian government also a little worried, and a meeting has been called. Would you say the balance of risks to growth have risen at all?
Yes, I think the external conditions, first of all, I think, they're certainly not very optimistic. And I think add to this threat of pandemic, I think it certainly increases the threat to growth.
Okay.
So I think in this, so at this particular juncture, I think this is an added dimension.
Yeah, added dimension against growth, I would assume. Yeah, the other point I forgot I wanted to ask Ashima, you point out that even our imports have started falling, and that shows deceleration of the economy. I therefore went back to the November import numbers. They've hardly fallen from 56 billion to 55 billion. And it's possible that most of it is because prices of what we import could have fallen globally. I mean, we import coal, we have imported petroleum, of course. So it looks like there's hardly any impact on imports. On the contrary, there is an argument that because India is the fastest growing country, or one of the fastest growing countries, there is a chance that because of that, our imports are rising. So would you not say that for the benefit of current account deficit, we may have to control the demand for imports, and therefore rate hike is one way?
Yes, that is the reason I agreed to a rate hike, because I feel that one instrument that has reduced domestic demand further to moderate imports. And I don't think I said that imports have fallen. I said that they're decelerated.
Okay,
That's what the growth rate, you know.
Okay,
So
okay. Yes,
I
agree.
And that
Sorry.
other things, that other instruments are available. Overall, I think that we have become so import dependent in unnecessary things because we didn't build capacities in the last decade. So sustaining investment is very important. This green investment where we reduce our dependence on oil imports. So, import substitution where oil imports are concerned. All this, these are long-term or medium-term trends which are very positive for the economy.
Yes.
If we can kick our over-dependence on oil imports, then a major source of external shocks will be behind us. So we have to work hard at that in this
Fair
period.
point. Fair point. Out of time, but I've got a very good idea of where each of you stand in terms of the growth-inflation balance and where we are at this point in time. Dr. Varma, Dr. Goyal and Dr. Bhide, thank you very much for joining me.